Welcome to part 2 of trading options on Robinhood. We're going to cover puts in great detail in this video. I only gave it 5 minutes of attention in the last video, and I just don't feel like that's quite enough. And I don't think many of you guys do either. Now, if you haven't seen part 1 where we cover calls and other very important concepts, you have to go watch it for any of this to make sense. So it's going to pop up in the corner here. And both in that video and this one, make sure you check the pinned comment for important corrections and information. Towards the tail end of the last video, I started discussing puts, but I kind of just glossed over it. However, I'm not going to repeat what I've already said. So if you don't remember what it's like to exercise a put option, go back to the last video, skip to 1 hour, 6 minutes, and 45 seconds. And that's when I start discussing puts. I'm not going to repeat what I've already said for those who are coming straight from that video. Okay, now we're going to take a look at this 43 strike put that has a premium of $4.50. So you'd be paying $450 to buy this put option and have it in your possession. Now this premium, much like with calls, can be divided up into 2 sections, which should sound very much familiar. So it's going to be intrinsic value and extrinsic value. Our friends, I bet you missed them. As we've discussed, intrinsic value is whatever you could exercise the option for, whatever value you could get out of this option through exercising. So if this option is 60 cents in the money, which it is, the current trading price is $42.40, the strike price is $43, it is 60 cents in the money. That means if we exercise, we're going to make $60. So however deep it is in the money times 100 is the value you would extract through exercising this option. So we would extract $60. Whatever is left is going to be extrinsic value, which is going to be $3.90. Extrinsic value with puts is time to maturity, kind of combined with implied volatility. With calls, implied volatility is good. With puts, same deal. Implied volatility is great. Your risk is capped to however much you paid for this option, which is $450. The worst that can happen is you lose $450. The best that can happen is you make an absolute crap ton. So you want to have a lot of volatility because it has a higher potential of making you more money with a defined amount of risk, which is the exact same for calls and puts. If implied volatility is high, the option is going to be expensive. If it's low, the option is going to be cheap. As time passes, extrinsic value is the portion of the premium that is going to decay. So even though this number is going to increase as implied volatility increases, it will disappear by expiration. We talk about the ability to exercise because it is what drives premium. But most of the time you won't exercise. The vast majority of the time it is not cost effective to exercise because you're going to give up extrinsic value. More realistically, when you exercise, you're giving up the entire premium, but you're going to make the 60 cents through exercising that option anyway. So you're just giving up extrinsic value. So we look at exercising because it drives premium, but really how you trade options is just buying an option at one price, hoping to sell the option for a higher price and get a profit out of it. So I don't have any questions at the end of each section. Instead, I'm just going to tell you what's different between calls and puts because a lot of it's going to be very similar. What's different here? Almost nothing. The only thing that's different is what's in the money and what's out of the money because it's flipped. When your strike price is above the share price now, it's in the money, where with calls, that'd be out of the money. So intrinsic value is going to be given to puts where a call with the same strike price would have no intrinsic value because it would be out of the money. So here we're taking a look at option statistics of a put. If you forgot how to get here, what you're going to do is tap on an option and then you're going to tap on the bid-ask spread, those 2 prices that look kind of hyperlinked, and it'll pull up this page for you. The bid and the ask operate very much the same. You're going to be buying at the ask to get in immediately, selling at the bid to get out immediately. And the rest of these are all exactly the same as calls. So we are going to ignore that. There's no reason repeating ourselves too many times. So we're going to focus on the Greeks. And the most notable difference between puts and calls as far as the Greeks go is that delta is negative. If you remember, delta is the change in premium given a $1 move in the underlying. With call options, delta is positive. That means that when the stock price goes up, we'll say S sub 0 increases, your call premium increases, and it's going to increase by a factor of delta. So in that sense, you're betting on the stock price going up. You're hoping that the stock price goes up because as it goes up, the value of your call is going to increase. With put options, delta is negative. That means as the stock price goes up, your put premium goes down and vice versa. So as the stock price goes up, your put premium goes down. It's the wrong way. As it goes down, your put premium goes up. So in that sense, it's a bet on the stock price going down because as the stock price goes down, the value of your option, your put option increases and you could hopefully sell it for a higher price than you bought it for. Now, theta is also negative. That's because as time passes, the less time to maturity there is, time to expiration, the less time for it to get in the money or deeper in the money, less time for implied volatility to take effect. So the less valuable your option is going to be. And this is how much your extrinsic value is decaying each day. Vega is also positive. It's positive for both calls and puts. Vega is saying how much your options premium is going to change by given a 1% increase in implied volatility. So it's positively correlated with implied volatility. If implied volatility increases by 1%, you're going to make $5 or 5 cents in premiums terms. And again, gamma is how much delta changes given a $1 move in the underlying. So delta is going to change. So for call options, delta is between 1 and 0, where a very, very deep in the money call will have a delta of 1, and a very, very deep out of the money call is going to have a delta of 0 or very close to it. With put options, it's between -1 and 0. Same deal though. The deeper in the money you are, the closer to -1 you're going to be. The more out of the money you are, the closer to 0 you're going to be. So in this sense, if you're buying just a single option, you're going to have technically more leverage with in the money options because they're going to have a higher delta. However, if you buy a bunch of out of the money options, maybe even this for the same price of one in the money option, you could potentially have a higher delta. So out of the money options do provide you more leverage when spending the exact same amount on them. Even though an individual one has a smaller delta, a bunch of them will have a higher delta than an in the money option for the exact same price. So that's the appeal between out of the money options for a lot of people, is that if things move quickly in the direction you anticipate, you can make a lot of money because your delta is going to be very high. The overall delta of your position is going to be very, very high for a relatively cheap price. But if things don't get moving, your premium melts away quite quickly. It's also worth noting that for both call options and put options, Vega is highest at the money. What that means is you're going to have the most exposure to implied volatility when you're at the money. That's because there's a lot of uncertainty with at the money options. Are they going to get in the money? Are they going to get out of the money? There's more emphasis put on implied volatility and volatility as a whole for at the money options because that's what predicts or determines their future. Extrinsic value is also higher as a whole at the money, but we'll get into that in just a moment. So what's the difference between calls and puts as a whole then? The only difference really is that delta is negative with puts. Your bet is going the other direction. So delta is between -1 and 0, while with calls it's between 1 and 0. Now, rho is a little different. It's negative for puts, positive for calls, but we really don't care about rho in trading. It's not worth bothering with. So it's just delta. That's the only thing that's different between calls and puts as far as their Greeks go. Now, of course, a call and a put with the same strike price is going to have very different looking Greeks, but the way in which they operate is going to be very much the same. Now we're going to take a look at how convergence affects put premium. It'll also help us really evaluate the differences between calls and puts when we're looking at these premium and payoff diagrams. And you'll see what I mean here in just a second. So on the left here, we have a premium diagram, which is just going to describe what our premium is over different strike prices or stock prices. We're going to show our payoff diagram as well, which is not going to look like this. I don't know why I drew it like that. There we go. So on the y-axis here, we have our put premium, and on the x-axis, we have the stock price. And up here, you can see that our strike price is 20 and our put premium is $1. So all the way down here, our put premium is 0. And you can see where it hits 0, which is when the stock price is above our strike price, when we can't exercise for any value. And I should say that we're looking at intrinsic value here. The blue is IV, which means we're looking at the value of the option at expiration. So when you can't exercise for any value, when there is no intrinsic value, that means that the stock price is above our strike price. Our put option is out of the money. And you can see our put option is out of money in this section because that's when things start going flat, when your premium is 0. So right here is going to be your strike price of 20. After this point, once you start getting lower than your strike price, you're going to be able to exercise for some value, or you'll have some intrinsic value, where maybe at this point you'll have intrinsic value of $1. Now we know exactly at what stock price you'd have $1 of intrinsic value, because for every $1 you're in the money, you can exercise it for $100 to extract $100 worth of value, which is $1 in premiums terms. So we know that this is 19. If we have a strike price of 20 and the stock price is 19, we can sell 100 at 20 and buy back for a cheaper price of 19 for each of those 100 shares, making a $100 profit. So we have $1 worth of intrinsic value. And that's going to be the case for every dollar you're in the money. So over here might be 18. That would mean we have $2 worth of premium. Now, any day prior to expiration, and things do not look like this. They do not look like this hockey stick. They look a lot different. In fact, your premium is going to look something like this. We're now given the same stock price. Your premium might be something like $4. And this is because there's that time to maturity as a function of implied volatility aspect built into this. You have some extrinsic value. And that's what this yellow line represents. And it represents that extra premium for time to maturity and implied volatility. So right here, we know that the difference between these two is 3 points, which is our intrinsic value. The total value of the option is $4. We have 1 point of intrinsic value. What's left over is all extrinsic value, which is $3 worth. Now, if implied volatility expands, extrinsic value expands. So it'll look something like that. Maybe not quite, but something like that, where now your premium is going to be higher than it otherwise would be, given the same stock price and the same date, just because implied volatility expanded. Now, if implied volatility contracts, the exact opposite happens. Your premium is going to contract, and now your option is going to be worth less, given no change in date or stock price, but just a change in implied volatility. Now, over time, excluding implied volatility, as time passes, this yellow line is going to start caving in on this blue hockey stick here. So eventually, extrinsic value will decay away over time, and your premium will decay, become smaller and smaller over time, until all that is left is this blue hockey stick, just like we discussed with calls. So convergence is what this process is called, and it's the exact same process for both calls and puts, but also explains how implied volatility acts similarly on calls and puts, as well as the passage of time. But you can see just by looking at this, how this is bowed out like this, that we have the most extrinsic value when we are at the money. Like we kind of mentioned earlier, this is because there's so much uncertainty with at the money options. Implied volatility in time is going to determine whether or not this option ends up in the money or not. So there's a lot of emphasis put on extrinsic value. And right here is also where Vega is highest, which makes sense because if we have a small increase in implied volatility, over here it doesn't change the premium a whole lot, but in the middle, it's going to have a bigger distance from where it once was. While on the tail ends, it's only going to be a small change. So because extrinsic value is highest at the money, and because implied volatility is what decides whether or not it gets in the money, this is where Vega is going to be highest. This is where you're going to have the most exposure to implied volatility, or to changes in implied volatility. Now, if we think about what calls look like, just to remember, when we're looking at a premium diagram of calls, it looks very similar. It's just going the other direction. So it looks something like that. And you can see how our premium is capped because if the stock price goes to zero, this is where we end up. We can't go any higher as far as premium goes when you're looking at intrinsic value. Down here, your profit is uncapped because the stock price can go up as far as possible. It could theoretically go up forever, which would be sick. And this is your call premium again. But the way convergence acts on both of these is very similar. With calls, it's going to be extrinsic value is going to be highest at the money, and over time, it's going to decay. And as implied volatility increases, this increases. As it decreases, this decreases. Okay, over here, we're taking a look at a payoff diagram. So we're looking at a profit and loss given different stock prices. The stock prices on the x-axis, profit and loss on the y-axis. And we're going to draw something like, so all the way down here, we lose what we've put into the trade, $100. This is if the put options out of the money and expire was worthless. But once the stock price starts going lower, below our strike price, we start making money. So we know our strike price is right here, and our strike is 20. We have to first make up the $100 we spent before we actually start making money. So to make up that $100, we have to at least be $1 in the money because we don't get to keep that $100 when we exercise. That stays with the option seller. In fact, it stays with the option seller throughout the duration of the trade technically, but it's easier to think of it as when you exercise, it stays with the option seller. So if it stays in the option seller's pocket, technically from when you first buy the option, then we have to make up that money because it's already gone. So once it's $1 in the money, once you hit $21, we can exercise it for a profit of $100, which compensates our loss of $100 for paying for this option. So we have hit our break even. So we first have to make up the money we pay before we can actually start making a profit. However, any day prior to expiration, it's going to be way different. Your break even is going to be way different. Because of that extrinsic value, our break even might be somewhere over here. And as time passes, our break even is going to change until it ends up right there on expiration day when there's no extrinsic value left. So to calculate our break even in more realistic terms, our break even is going to be equal to the strike price minus the put premium we paid. I'm so sorry. This is supposed to be 19, because I'm so used to looking at calls. $1 in the money means that the stock price goes down $1. I'm so sorry. So strike price minus our put premium. So 20 minus our $1 premium gets us to our break even of 19 on expiration day. But any day prior to that, our break even is going to be a little bit higher. So over time, as theta degrades your premium, you're going to have to hope the stock price keeps pushing downwards because our break even is going to start getting lower and lower and lower as time moves on, as extrinsic value decays. Now, if we think about a call option, what does that payoff diagram look like? Well, if you excuse me drawing it right in here, it looked very similar. It was just going the other direction, but the exact same concepts still apply. So here you can see really in a broader picture, how calls and puts are so darn similar. They're very, very similar. Everything's just kind of flipped the other direction. So what's really different here between calls and puts? The process of convergence is the same. The payoff is basically the same. The concepts, the way they work as far as in the money, out of the money, convergence and payoff works is almost identical. Obviously, the in the money and out of the money is flipped, which is going to cause our break even to be different. So normally with calls, it's strike plus the premium you paid. But with puts, it's strike minus the premium you paid because everything's flipped. But the process of convergence and the idea of profit and loss based on in the money, out of the money, and how much you paid for the option is very, very much the same. Just kind of mirrored. In the future, there will probably be a part 3 where I cover spreads. And if there is one already, you will find it at the end of this video. If it's not there, I haven't made it yet. Thanks for watching, guys. I'll catch you in the next one.